Hello, everyone, and welcome back to a new episode of the TFDI podcast, brought to you by the Trade Finance Distribution Initiative. Today, we receive Alexander Malaket, the president of OPUS Advisory International. Alexander is a well-known figure in the trade finance world, having been deeply involved with industry initiatives such as the ICC Trade Register, the ADB, BAFT, ITFA, and others. He's here to talk to us about why previous attempts to make trade finance an investable asset class haven't necessarily had the expected results, and how we can make sure to avoid repeating past mistakes. Welcome, Alexander. Thank you for being here.
Thank you, Melody. Thank you very much to you and to ITFA for having me. And thank you for Andre Kusterman's suggestion that you and I have a chat this morning. I really appreciate it.
So you've been working in the trade finance sector for a long time, and particularly collaborating with industry associations and multilateral initiatives. So I wonder if you can tell us how big of a theme trade finance distribution is in these forums.
Right. I think that's a great way to start the conversation, Melody, in the sense that from my perspective, it's been a bit of a roller coaster ride. There have been periods where it's been a bit more topical, and other periods where it's been at least in practice handled as something of a secondary priority in terms of developing the asset class. And I should also add a bit of a nuance, which is to say that it's not necessarily about making trade finance investable, because there are people who actively invest in the asset class, and that includes a number of different types of entities and organizations. And there are a number of different parties in the market, including banks and multilaterals and others who distribute the assets. I think it's about making the asset class more investable and advancing its visibility within the capital markets. So there's this overarching requirement from my perspective, which we've talked about as a kind of a bridge building exercise between the capital markets and the trade finance practitioners in the trade finance market. And it's a little bit that bridge building, in my view, that's at the center of the challenge that we face at the moment.
Okay. And what are some of the challenges then that keep coming back when people talk about making trade finance then not an investable asset class, but when people talk about bridging this gap then with the capital markets?
And again, well phrased and astute question, because there are these recurring sort of repetitive challenges that come back. One of them is the question about whether this is a priority or not. And so, I can remember back, as you pointed out in your introductory remarks, there have been a number of initiatives, probably 4 or 5 over the last decade or so. And you can trace back that kind of arc of history to say, there are periods when, for example, the banks, who certainly in traditional trade finance are the primary distributors of those assets, they'll view this as a kind of let's say, a solution to an immediate problem. So at some stage, the banks have ample balance sheet capacity and ample risk tolerance, and so they're quite happy to do the business, originate the business, and then hold it to maturity. And then there are other periods of time when it seems like there's a limitation on capacity, there's something that happens from a risk perspective, something happens from a balance sheet or capital cost perspective that suddenly motivates the industry as a whole. So I'm not speaking about individual institutions, I'm making sort of an overarching statement, to suddenly talk about, wait a minute, we better start thinking about the originate to distribute model as opposed to originate to hold to maturity model. And so there's kind of this inherent cyclicality in the conversation about whether or not distributing assets and investing in trade finance is a priority. And what's interesting to me as a kind of I'd say slightly arm's length advisor to the industry, is I've had these discussions with senior trade leaders to say, this is a kind of an interesting approach to react to current circumstances, but isn't trade finance fundamentally cyclical as a business? And therefore, even if you have ample capacity today, won't there inevitably be a time, whether it's 6 months or 8 months or 18 months down the line, where you will need to distribute the assets? And if the answer is yes, wouldn't you want to prepare for that at the moment when you've got ample capacity and you're not in a firefighting exercise? So it's those types of conversations that make this whole topic extremely interesting, and at the same time make it challenging. So one of the recurring challenges, to come back to your question, is this slight sort of back and forth about whether distributing assets and developing the asset class more than it is already is a strategic priority and a priority for the industry or not. And then one of the other recurring challenges, which we alluded to a minute ago, is the question of how well do trade financiers understand how capital markets work, how investment and asset managers make their investment decisions. What are the priorities they're looking at? What are the characteristics of investment alternatives they're looking at? And then vice versa, how well do the capital markets folks who are in decision-making positions about where to invest the money, are they even aware of trade finance, first of all, as an investment alternative? And then secondly, how well do they understand the business? How well do they understand the credit risk profile, the fraud or operations risk profile, the transactional character of the business? So there are those kind of recurring elements of awareness, and I would almost say kind of mutual education that also keep coming back.
Interesting. So I guess the biggest challenge is to make this initiative a consistent priority, not just a cyclical priority, in order to develop the market, before we can talk about commercial and technical challenges, right?
So I think the answer is yes, and that speaks directly to the character of the assets that are available for investment. I mean, one of the things that we hear consistently from the investment side is that they need, depth of asset pools, and they need the ability to, acquire and sell assets. And trade finance in general isn't currently a very deep pool of assets, and you don't have the ability to go in and out of the market as quickly as some investment managers would like. And part of that, in my view, comes back down to the question of how active are the banks and others now. We're talking about non-banks who also engage in trade finance, including supply chain finance. How active are they in the distribution of those assets or in the sale of those assets into the market? So I think those two things are very directly sort of tied into each other.
Mm-hmm. Great. I wonder if you've witnessed throughout your career any specific initiatives by trade finance bodies to make this market transformation happen, and if you can tell us a little bit more about them.
Yes, Melody, there have been a number. So, I mean, I can remember back to the days when BAFT launched something called the London Group, which was mandated to start to think about this as well. I would say, and I'd say peripherally involved at that point. So my comments, take them with a pinch of salt in that respect. But I think that initiative was probably a little bit ahead of its time. It was a thoughtful initiative, and it was the right thing to start thinking about, but I don't think the market was ready for it. And I don't think there was enough appetite to have a serious industry-wide conversation, even though over time there have been individual institutions that have distributed, significant size asset pools and portfolios into the market. But at the industry level, I think it was a little ahead of its time. And then subsequent to that, the ICC under Kachai Tan, when he was chair of the Banking Commission, attempted to do something like this, partly under the auspices of the ICC Trade Register, where we collect default and credit risk data on trade finance. So it seemed like a logical kind of pairing of those activities. On that one, I would say that it was very much a question of that mismatch of the bank's desire to distribute versus the requirement to do that in the market, or to present an investment alternative in the market. One of the things that's happened since then is this greater consciousness, and this is thanks to Stephen Beck and the Asian Development Bank and the work they've done on the trade finance gap for well over a decade, which now sits under the auspices of the ICC, but originally was funded and initiated and conceptualized by the Asian Development Bank. There's now this very significant awareness of the trade finance gap, and we know it as practitioners. It's now well known among policymakers. It's extremely well known in international institutions like the UN, the B20, G20, all of these sort of fora. And so now with this trade finance gap, we have given some thought to, we recognize that the banks are very unlikely to fill that 1.5 trillion or whatever the number is today post-pandemic. Some say it's doubled or possibly even more than that, that the banks are unlikely to fill that gap anyway. And so the distribution of assets, the sale of assets, and the creation of net new capacity by attracting non-bank capital into the market is becoming imperative, almost urgent, with that sort of lens in mind. And so that's one of the sort of macro evolutions in the market that's helping drive the discussion around further developing trade finance as an asset class. And then the other piece is, when you think about where we are in terms of sort of zero interest rate environments, negative interest rate investments, all those sorts of things, there are large pools of capital looking for a home, whether it's a short-term place to park the capital until there are alternatives that are determined or discovered, or whether it's a bit more of a strategic play for the investors to say, hang on a minute, this is an interesting asset class, and on a risk-adjusted basis, even though the returns might be a bit modest on a risk-adjusted basis, it can actually be quite attractive.
Mm-hmm. Okay. I wonder what lessons we can learn from the previous initiatives that you've mentioned in order to make sure that that trade finance distribution to institutional investors really achieves its full potential this time. Could you sum up the key lessons from that?
I'll see how well I can do on that question. Melly, two other things I should mention in terms of other initiatives. So Andre Casterman actually, interestingly, did a lot of work with Euroclear a couple of years ago as they were trying to consider whether they wanted to become kind of the SWIFT of trade finance distribution. So that was an interesting initiative for people who might be listening to this podcast or viewing this video to look into if there's some documentation in the public domain in terms of lessons learned. And then more recently, of course, the ICC has revived this initiative under what we call the IITF, the Institutional Investors in Trade Finance. We had a number of work streams under this, which will go to your latest question, which is around the lessons learned. So it really is about the fundamentals. There is an education and awareness raising that needs to happen. But if I go back a step, it's probably less about bankers sitting around a table talking to each other and a lot more about including the other stakeholders in the conversation. So we tried to be more thoughtful about ensuring that we had investment management representatives, fund management representatives, insurance folks at the table with the banks. And one of the things that Sarath Sengupta and I, who co-chair the ICC initiative, or did until recently, were really driving home to this group is to say the bank perspective cannot dominate the conversation. It needs to be a much more balanced discussion. And then, as ITFA has done with TFDI, it's a very smart play to bring in the technology piece. And to do that in a kind of a neutral manner, in a trusted environment, to say, look, there are some key pieces here. Having all the right players at the table is a key piece. Raising the education and the awareness level is a key piece. Learning to speak each other's language is important. That whole bridge building image that we tried to draw earlier. And certainly thinking about the enabling capabilities, including the technology, is a key piece as well.
Mm-hmm. I love that you said a bit earlier that the overall awareness of the trade finance gap has grown a lot in recent years, and that's playing a big part, I guess, in making trade finance distribution more of a constant priority, the challenge that we mentioned at the beginning of this conversation. So that's a really interesting development. I wonder if there are other macro developments that you think can assist or also hinder the development of a thriving trade finance distribution market?
Well, that's an interestingly phrased question, and you've covered off both ends of the spectrum on it. So I think the answer is yes on both. As I mentioned, the current interest rate and return environment certainly argues for new alternative investments to come up and to be promoted or advocated for or raised as alternatives for investment managers who need to achieve certain objectives. So we know, for example, that pension funds are notoriously underfunded almost on a global basis. And so, pension fund managers and executives have a huge challenge in terms of making sure their pensions are well funded. So they'll be looking, and they are looking and have been for quite some time, for attractive investment alternatives. And again, as I say, from a trade finance perspective, and I recognize here that we're speaking very broadly, and there are variations in the types of investments and instruments and all of that, but we don't have time to get into that in this discussion. But trade finance can be interesting from a risk-adjusted perspective, again, for these types of investment objectives. Similarly, insurance companies who are regulated in terms of where they can place their investments and the types of baskets they can create, again, trade finance can be interesting in terms of meeting those requirements. On the slightly more dangerous side, and it would be difficult to go through this conversation without mentioning the Greensill debacle, and I'm not interested in getting to this in any great detail, but I'll just say that perhaps counterintuitively, one of the outcomes of Greensill has been that it's raised the visibility of supply chain finance, even though I think what we'll find is that a very small percentage of Greensill's business had actually anything to do with supply chain finance, but it's been in every tier one publication and report, and every sort of industry report on the topic has linked Greensill to supply chain finance, as they did in their own marketing efforts. So that visibility piece has been one outcome. It hasn't always been of a positive nature, but we're doing things at the industry level to try to reframe or correctly frame the conversation to distinguish Greensill's activities from supply chain finance. So we're trying to ride the positive wave of visibility here. And curiously, what that's done, or maybe it's not so curious for those who know how these things work, is that it's actually generated significant interest among investment managers, and they are actively looking at, and I understand from some unofficial conversations, there have been some net inflows into trade finance funds, probably as an indirect result of the Greensill mess. So, there are a number of dynamics at play that will continue to be at play for the medium term, certainly including the macro environment, including this story that won't go away for some time. And then the continued sort of discussion around post-COVID recovery. That's the last piece I'll mention. Is there are a couple of things that will be critical to post-COVID recovery. One is trade. The other is the re-engagement of SMEs in the market. So when you put those two pieces together, you can very easily imagine how the challenges of trade financing, including deep tier financing and access to trade finance for SMEs, how that can tie into creating pools of investment assets, bringing in net new capital to finance the long tail and finance SMEs. All of those pieces kind of tie together very neatly. And so there are definitely a number of factors that will continue to drive this as a priority in my view.
So I like to end this podcast on a more personal note and help our audience get to know our guests a bit better. So can you tell me what's the latest thing that you read or heard that sparked your curiosity? And it doesn't have to be trade finance related.
Thank you for that. So there are a number of things that spark my curiosity and create confusion for me almost on a daily basis. So that's a tough one. But two things I might mention. One is I've become very, very interested in the ESG and sustainability space over the last 2 to 3 years in particular, and more intensely so. So at a time where, as you can tell by the gray hair, a number of my compatriots and sort of colleagues are thinking about retirement and sort of gearing down a little bit. I'm signing myself up for certificate courses and going back to school on ESG in particular, partly because we've launched, as GTR knows very well, your colleagues at GTR or your former colleagues at GTR know well, we've launched a practice on ESG out of London with a couple of partners. So that's one area that's kept me extremely interested and engaged over a period of time. The other thing that's completely unrelated to business that's been extremely confusing to me follows an event I attended in December of 2019 in Toronto, where I heard Dr. Deepak Chopra speaking, and it was probably one of the most engaging, let's say, interesting, challenging talks I maybe have ever heard, and I'm not one given to superlatives. And so I'm trying to figure out his book now called Meta-Human, which is extremely interesting, but has an amazing way of turning your worldview completely upside down. So it's a book I can manage at sort of a couple of pages at a time before I get so confused I need to put it away and go think about what I just read. so that's those are two things that are.
That sounds like a good thing, I would say. A book that makes you think.
It is. So two things that have, as you said, sparked the curiosity and as I said, kept things sufficiently confusing to keep things interesting.
That's great. Well, thank you so much for sharing that with us, and thank you for all of your insights. We've run out of time, so I'd like to take this time to thank our audience for listening to us and encourage you to share any comments you have in the comments section. Thank you very much.
Thank you, Melody. Thank you, everyone. And thank you, IDFA, once again.